Hi there, traders. Now, this week we had a number of traders getting caught up on the price action following the release of the US CPI numbers. Now, this number was a big number in the scheme of things, comes on the back of really weak US non-farm payrolls last Friday. Unemployment, CPI, the two big connectors for the central bank, when they are starting to look at changing rates and their forward guidance and all those sorts of things. So really big number. But the problem is with the result, okay, and sometimes the numbers are good to trade, sometimes they aren't. This was a situation where strong numbers, the market wasn't really exactly sure how the market was going to respond, right? So let me just come to the charts and make this a little bit easier to explain. So we had the big move down, the big move, down on the dollar. You can see here, I was looking at euro, up in the dollar. So this is following the non-farm payrolls, right? The dollar then finds fair value once that's factored in, starts trading sideways. The impact of a higher CPI in normal market conditions would be higher interest rates. But the Federal Reserve have come out and said basically, we're not going to do anything even if inflation is high. But the situation was, so let me just come back one step. So leading into the number, right, the best trading opportunity for us would be weak CPI numbers. The dollar just craps out. Okay, now let me just blow this, the dollar index up here. So that's the situation we've got. So you've got the non-farm payrolls, starts trading sideways as we wait for the CPI numbers. Now, as I said, the best trading result for us would be weak CPI. It comes on the back of the weak non-farm payrolls. Dollar just goes lower. The other situation is if the numbers are strong, what does it do? Well, stronger inflation numbers from what the Fed have told us, they're not going to change interest rate or their policy, right? Their policy plans. But the situation was the numbers came out so much higher than expectations, the market started factoring in higher interest rates anyway, right? And that's a commonplace thing. But check out the price action here, particularly these two bars here around the release. Now, a number that has mixed implications in this situation, the Fed saying they're not going to do anything, we get high inflation. It doesn't mean they're going to buy dollars, but the market will react pretty quickly straight away and go, well, higher inflation, they buy dollars straight away, right? And then they say, well, hang on, the Fed aren't going to do anything, right? So that it just corrects itself. And what you get is convoluted price action. Liquidity at the time of this release is very thin. And what that means is wider prices and the currencies move around a lot more. This was commonplace across a whole range of instruments. Now, let me just come back and show you euro, right? A bit more, almost a better example of what was going on, because the euro had a really crazy sort of release. It sort of goes from 120.55 up to 45, back down to the figure, and then started going up. So what I want to highlight is the problem of trading numbers when there's a mixed view of what the numbers mean. Now, let me just give you the normal situation here, okay, or another view. Say the Fed had said, if we get really high inflation, we're going to have to raise interest rates. You could get into the currency as soon as you can, and it would go higher. You would not see that correction after the initial spike, right? But this wasn't the situation we got into, okay? So you got to understand the numbers and which ones are going to give us a good, clean trading opportunity at the time of the release and which ones aren't, right? That way you can avoid problems, right? And what I'm talking about is problems with getting in at mixed levels. Now, if I have a look here across the board, there's the price action there on sterling. It jumped around a bit, but sterling's been sort of doing its own thing. The Aussie, the Kiwi, they all had this. Even the dollar CAD and dollar yen initially sort of spiked and sort of sat there. So, and dollar Swiss for that matter, and obviously the dollar index. So they all had this crazy price action. Now, it wouldn't matter if you got in straight away, you'd probably be stopped out. If you're watching price action, you can get caught up into getting short or not. One thing to do, let me just explain the best scenario here, what you can do. Identify the potential release. Is it going to give me a clean opportunity? as I said, if the numbers were weak, we would have a clean opportunity to sell dollars and you make money. If it's a strong number, it's got a mixed signal. It's very hard to understand. Sit back and wait. Don't trade those numbers on the release itself, because you want to see how it impacts, and the way the markets are behaving at the moment. You want to see how these numbers come in, impact the equity markets and the bond markets. Sure, you give up a bit of the price move, but I tell you what, in a situation like this is a classic example of how beneficial it is, right, to wait for these numbers. You see the huge numbers and you go, okay, if you waited, you missed that first hour of crazy price action. If not first half hour, it's probably all over by then. You start to see the initial move come out, and then the market started to go. So we saw initial dollar strength. The market recalls that the Fed aren't going to do anything. It drops back down. Then they come back and go, well, you know what? These numbers were much bigger than expected. The dollar starts marching higher, and that's the move. Now, what can happen though? I want to sort of focus on what can happen in this situation. And this is very commonplace in the banks as well, around what traders psychologically would end up doing. Now, at the time of the release, right, you go long, say you're getting long up here and you get flushed out on the move back down, okay, you get stopped out. Now you're nursing a loss and the currency starts going up again. This is a really bitter pill to swallow. You'll have a massive amount of anxiety. You feel like you've let yourself down. That's all well and good. But what you did, you've got to understand, before you trade into a situation like this, you are getting into a highly volatile, high risk situation. So understand that. In that situation, I would always reduce my trade size at the very least, if not just wait. Now, if you have a loss here, this is what invariably will happen to you, right? You get in, you get stopped out, right? And you see the thing starting to move to the top side, as in the dollar rallying. Now, just because you missed it, right? What more often than not happens, when it gets up to here, like let's say the dollar index, for instance, you've missed the initial 40-point move. So for some weird reason, traders start to look to sell. They look like, you know what? I've missed the initial move. I'll pick the top. Okay, I'll pick the top in dollar CAD. I'll pick the top here in dollar yen, dollar Swiss, and I'll start to sell, looking for levels to get short in the other pairs. But what you end up doing is you end up screwing it all up, right? When the data comes out and it's clear what the direction is, right? Dollar strength, right? These pairs should be going up. And this is what you got to get really clinical about. And these pairs should be going down, right? So let me just get these arrows in there. So at that point there, right, you've got to think, I'm a buyer. Now, I know you've already bought and you've been stopped out. The fact that you got stopped out psychologically changes your mindset. You're thinking, well, I was a buyer, I got stopped out, so now I'm a seller. It's absolutely, this ends in catastrophe, right? Because you're a buyer, you end up selling, what you're trying to do is get your cash back. Now the cash is gone. When you come up to a trading opportunity like this, you've got to be very hard-headed and say, you know what, if I get the first trade wrong, I'm out. You don't have a choice to go back in. But for some reason, traders start trying to pick tops here in all these other pairs, right? Let me just change the color of that pen. So they're trying to pick tops. This is problematic, right? Because the currencies can start like moving against you the other way, and you start getting, you start getting short dollars, right? You're starting to get long. You think, oh, well, I'll buy euros down here. I'll buy some sterling. I'll buy some Aussie. I'll buy Kiwi. No, you're not a buyer. The dollar's going up. You're looking for opportunities to get long dollars, not short US dollars, right? So this is a quick 1-2 scenario, right? Massive performance anxiety. You get long, it doesn't work out. So you start getting short. That is wrong. So what you do is you end up digging a hole, trying to get back that first initial cash. So before you go into trading these opportunities, make sure you understand what's the implications of the data release. Okay, is it going to be an easy situation? So there's that one there. Is this going to be an easy, clear-cut situation where I can get into a trade, right? Or not? if it's not clear, stay out of the initial price action, right? Because you will avoid wild price movements around the release. As I said, half an hour afterwards, once the dust settles, it becomes very clear what the market's going to do, right? Or not. In this situation, it did, dollar strength. So then you don't go in and start trying to short the dollar on the back just because you missed the initial move, right? If you miss the initial move, sit back, wait for your levels, wait for everything to calm down. The best trading opportunities and the clearest are obviously after the fact, right? As I said, if this was a situation where the Fed had told us already that the higher inflation would lead to higher interest rates, yes, get long dollars as soon as you can. But it wasn't the situation. So first of all, so 2 lessons here. Don't get yourself over involved on tricky releases like this one, right? You can get flushed out. If you want to get involved, probably decrease your trade size to half or a quarter of the normal position, right? It'll save you digging a hole. Lesson 2, don't start shorting the market, trying to pick tops in the dollar if the dollar's going up just because you missed the initial move, right? If you have a loss during the situation, right, you've had a losing trade, right, and you're out of pocket, swallow that, right? You can't get that cash back straight away. You've got to wait for the next opportunity to build. And it may be, if we got a really strong dollar situation, it would be buying it up through these trend lines, right? But we lacked momentum. There was as I said, a mixed issue with what the Fed was doing and what the implications for the higher inflation was going to mean. That's why the currencies have stalled. But the next opportunity will be better once we get clear understanding around the data or what the Fed's doing, right? So this is one of those lessons. Beware tricky numbers, right? First of all. Secondly, don't start going against the data once the trade has happened, trying to get your cash back if you've had a loss, right? This is a lesson that you need to really think about before you get involved trading the volatile economic data releases. All right, guys, I hope that helps. If it doesn't, drop us a line on the virtual trading desk and I can answer your questions. All the best.